Good morning, everyone. Welcome to Monday. Welcome to Monday Minutes. Hope everyone had a great 4th of July, great long weekend. If you had one, fantastic weather up here in the New York region. Busy week ahead. There's a ton going on. We've got the beginning of earnings season, Chair Powell on the Hill, CPI and PPI, long-end Treasury supply, and certainly dynamics around the election coming out of Washington, which continues to unfold. Heightened period here. Both the monetary and the fiscal side, central banks, after a long rate-raising campaign coming out of the pandemic, beginning the process of lowering rates. And at the same time, on the electoral side, even coming out of the pandemic 4 years later, the consumer, the voter, the electoral process, change is certainly in the air. Change is certainly in the air here in the United States with a very, very bumpy time frame here and process as we head into the conventions for both the Republican and Democratic parties. Here in the United States, look, the data has weakened clearly. Just as the narrative coming out of the first quarter into the second quarter has changed with the Fed becoming more hawkish, the data has shifted decidedly weaker on the growth side. Inflation now turning back the other way. So lower growth, lower inflation, certainly lining up with what the Fed needs here, which is below trend growth and the disinflation process reemerging. And at the same time, we did have this strong narrative in the first quarter of this bumpy inflation, but we had the same thing in 2023. That first quarter was very bumpy in terms of inflation, and then the numbers did nothing but come down into the Powell pivot late 2023. So, employment versus the establishment versus the household survey, we've been writing to clients for months about the revisions that are likely to come. You don't have to believe us. Just go back and look at history. It will tell you that these numbers typically are revised, and they're typically revised down. You look at temporary workers, you look at the amount of time that workers are in need or out of work looking for a job. There are a lot of metrics out there. You look at the jobs being created, largely in the same buckets: government, social services, healthcare. It's been the same story. So the Fed is watching. If there is a Fed put in the market right now, it's certainly on the employment side. The chairman has laid that out, that asymmetric bias in terms of the scenarios where, the Fed could actually begin easing rates. Is it conclusive right now? Is it definitive right now? I would say the answer is no, but it's certainly not moving in the right direction. And even if you look at the unemployment rate, which has done nothing but tick up. So plenty of more data between now and the September meeting. We do like that pricing right now, although it's close to the election. We've been saying to clients, look, the one rate cut in September is not going to make a difference. When you look at the dynamics that are going on in the United States right now with this election, they far transcend the potential for one rate cut in September. So we don't think that timing in terms of the election really matters here. What will matter, we do think, is the data moving forward. So no change at this month's meeting, obviously, but certainly we could get the beginnings if the data continues to show weakness and inflation continues to come in softer. We could show the beginnings of pointing the arrow toward that September time period to potentially begin lowering rates here in the United States. Directionally in the market right now, we do like this steepening bias. We can do it in bear fashion, bull fashion. We did it in bear fashion in 2016. We've done it in bear fashion, although very, very locally here since the presidential debate. And then to the extent that we have fiscal wins, which point to potentially continued spending and more pressure on the long end of the curve, the short end put in a great performance on Friday. Technicals look extremely good. We're making lower yield highs on both the short and the long end, which is what we will need to do if we're going to have some sort of constructive period in rates here short term. And keep in mind, bigger picture, even when rates are going down, they still went higher over time for decades. So the same way that we're in a pocket where rates are going higher over time here potentially, and people are extrapolating, there is still the potential for rates to go lower as rates are in a bigger trend higher. So directionally here, we do favor a steepening bias. On the long end, more of a range trade. We do get that supply this week, and all eyes will be on Chair Powell, certainly to be grilled in front of Congress. He knows his audience extremely well, and he will be questioned about high rates and certainly jobs He's got some wind behind his back here in terms of the weaker data. He will lay out a timetable where the Fed needs more data to become confident, but we wouldn't be surprised if he did strike a more friendly tone on the Hill this week. Wishing everyone a great week ahead. I'm Greg Faranello. I'm head of US rates for Amerivet Securities.